So I think it's better if we start now.
Yeah, we'll start now. Okay. Obviously, as and when people come in, we'll let them in.
Yeah.
But yeah, thanks everyone for joining this webinar. I know it's a very hot topic, and I've been asked many a times to do this. We have done this in the past with clients as well. So using pensions to buy commercial property is obviously possible. More benefits here for business owners. I'll obviously come to that, but the webinar is sort of targeted towards business owners who've got reserves and the ability to put money into pensions. But not only business owners. I'm also going to talk about individuals who are in the business of renting out properties or buy-to-lets. Perhaps this is something they can consider because of all the tax advantages of buying commercial property via your pension. So let's get straight to it. Today I'm going to cover what is a commercial property. So we'll go into depth on that because there are a few gray areas here, but we'll talk about it. And how really can you invest it, or rather buy a commercial property through your pension? And we'll cover all the tax reasons. So those are our objectives. Simply put, a commercial property is one that is used for business purposes, right? So any property that has a residential element to it is not considered a commercial property. By and large, that's the rule of thumb, right? So any property that has a business purpose is a commercial property. For example, you'll have pubs, shops, factories, agricultural land, obviously offices. You talk about clinics where you have medical equipment and you need that office to service your clients. So anything that has commercial sort of business reason aligned to it, right, is a commercial property. I said there are some gray areas, so which I'm going to cover in a bit, but anything which has a residential element, for example, houses, residential, flats, it's residential, holiday homes, back gardens, these are things which a pension cannot purchase, right, because of the residential element of it. So we just be aware. The exceptions that I was speaking about, for example, shops sometimes comes with a flat on the top. Now the flat is a residential space, right? So your pension cannot buy that property. However, if the deed were to be split between the flat and the shop, then the pension can buy the flat. Sorry, the shop part of it. So the deeds have to be split. Again, it's the same with a pub with a landlord, for example. Again, there's a small residential element there, or a farm with a house. Now the house is obviously residential, but the farm is agricultural, so it is commercial. So again, can be done, but needs more work. So we need to split the deeds, and there is a work around that. So just bear that in mind. Not all property is commercial, and not all commercial property fits this bill, right? We have to ensure there's no residential element to it. So who can invest into your or into buying a commercial property? So we're obviously, by and large, we're talking about pensions. Now, if there's enough money within your pension to go and purchase a commercial property, then fine, no problem. However, if funds are lacking, you can join with other parties. So, for example, let's take a business owner, right? And that person also has a pension. So, say their pension is not enough, but the business has enough money in there. What they can do is have a joint ownership. The business can own a percentage of the property, whilst the pension can come in and own the rest. So that's possible. So you can have multiple parties, pension and client outside, so pension and an individual. You can have multiple pensions. So, for example, you have, say, 3 directors in a business with 3 shareholders. All of them have individual pensions. What you can do is bring these individual pensions together and buy the property. So in that case, you'll have multiple pensions pooling together the funds to buy the property. And when that property is then let out, any rental income that comes in gets split in this example 3 ways, right? So that's possible. Multiple owners as well, again, similar to the first point, you can have a pension and an individual and a business. So all these sort of scenarios are possible. It just means, you have to be aware that more admin is needed when there are more individuals involved or more parties involved. But it is flexible. So think about scenarios where if the pension funds are not enough, then there are sort of other routes available to funding this purchase. Speaking about funding, obviously the easiest, the most simplest way to do this is via your own pensions, right? And an individual can have many pensions from previous employments, and so you can look at consolidating these previous pots into one pot, thereby having enough money to then buy this property. And also you can contribute, right? When I say you can further utilize, for example, business funds to make a pension contribution. Or if you haven't contributed in the last 3 years, or if there's any remaining allowances of the last 3 years, last 3 tax years, you can utilize those allowances and make a larger contribution. Just so that you can make enough money or have a sufficient pension pot to go and buy this property, right? And the other thing to remember here is pensions are they're allowed to borrow. So pension can borrow money, but it's got a restriction. It can only borrow up to 50% of its value. So what I mean by that is, let's say, for example, the pension has 200,000, right? And that's not enough to buy a property. What it can do, it can borrow 50%, so 100,000 in that case, and together 300,000. You can then, the pension can have therefore enough funds to buy that property. So yeah, borrowing is possible, and that can be in the form of a mortgage. So there are lenders out there who fund a commercial property purchase by giving a mortgage to a pension. But again, like I said, remember the 50% rule. Or you can have borrowings from other parties, like your own business. So say you've exhausted your annual allowance of pensions from your business. So say you've put this year £60,000 and you've utilized all the last 3 tax years. So you maximize your pensions, let's say, right? And your pot still is not sufficient to buy this property. What your business can do, if there are still cash reserves, it can lend to your pension. So you can have a loan between your business and your pension, again, up to 50% of the value of the pot. And that loan then gets repaid over 3 or 5 years. But it's a commercial loan. It will have a commercial interest element to it. So the pension, because it's borrowed money, will pay an interest. So the business is getting some sort of income from it. So all those scenarios can be workable, right? Where should the pension be lacking of funds, you can then look at borrowing money. So again, this is just how where you get started. Obviously, speak to an IFA to see what possibilities there are. When it comes to consolidating pensions, you probably want advice there. Not all pension providers are in the business of commercial property, so they might not like it. So you may have to look at those providers who are specialists at having commercial property as an asset in their pension. So an IFA, therefore, is someone you should speak with. For that mortgage, I said the borrowing bits. You could speak to a bank directly, or you could speak to a mortgage advisor who can get you some of the good deals there. Obviously, when searching for a property, estate agents come in, and then once the deal is done, you have solicitors, and don't forget there is a pension administrator. So SIP here now for your self-invested pension policy, so you need a SIP to do this transaction. And there are SIP providers, we call administrators, who will oversee the process, who will sort of approve the property, will look at the property, make sure there's no residential element to it. So yeah, there are a few sort of stakeholders here in this process. And of course, once, consider this an actual purchase, right? So you'll have obviously the listers. If there's a mortgage there, you'll have valuers and surveyors coming in, and so there's stamp duty to be paid and all that. So it is a purchase, and so all those sort of elements come in. So what are the benefits? So again, I'm talking. Obviously, I'll speak about benefits for businesses, but a pension, generically, whether that's invested in the stock markets or in property or what have you, it lies outside of your estate, right? Now that's important because all your other savings, your property, your wealth, everything is obviously in your estate, and that is subject to inheritance tax on that, right? But your pension sits outside of your estate, so it's not subject to inheritance tax. Now, I think that's an important point to mention, because if you're in the business of, or rather, if you have a few properties in your pension, obviously all those are assets, and if it's outside of your estate, then there's no inheritance tax implication on it. So good point to note. Obviously, income tax. So when the pension has commercial property as an asset, obviously you need to rent it out, right, to get any income out of it. So the income for the pension is rental income. Now, unlike personal landlords or buy-to-lets or even companies, like special purpose vehicles, where you've set up a company to buy a buy-to-let, or in those scenarios, the rental income is taxed. So a limited company will pay corporation tax. An individual will pay income tax. But a pension pays no tax. So that's one of the main advantages of buying a property, a commercial property, renting it out, and all rent coming in to the pension is tax-free. So, a very good tax incentive. Now, for a business who's, looking to do this and looking to utilize business reserves, when a business contributes to a pension, so let's say to a director's personal policy, obviously all those contributions are, the business is saving corporation tax, right? So there's tax savings when money goes in. There's tax savings when rent comes in, and so it's there's a lot of tax incentives for doing this, and also individuals. Say there's no business, but as an individual, as a personal landlord, I want to invest in a commercial property. I could look at contributing to my own pension, right? Or I might sell one of my buy-to-lets, use that money to put into my pension, and with that money, buy a commercial property. So any money that I put into a pension is going to save me some income tax. Because if I was a high rate taxpayer, any personal contributions I make to my pension gives me 40% tax relief. So contributions into pension is saving tax, right? Capital gains tax, again, we're saving here because whilst the property is within the wrapper, within the pension umbrella or wrapper, as we say, there's no capital gains tax. So, in 10, 15 years when that property is sold, the money comes into the pension again, but the pension doesn't pay any capital gains tax. And so that's brilliant, right? Because as an individual, if I'm selling off a buy-to-let property that I own, I have to pay capital gains tax. As a company, you have to pay corporation tax on the gain, but pensions don't pay any taxes. So lots of tax benefits in this scenario here. But specifically to business owners and to businesses, especially those businesses that are sort of occupying an office space, which they're renting out, and they have the sort of means to buy that property, it makes complete sense. So, for example, say a business is renting out its existing office, right, and has enough, let's say, reserves to buy that property. What it can do is contribute to the director's pension. Obviously, by doing that, you save corporation tax. The pension then buys this office, right? And so what then happens is the business rents the property from the pension. So the business is paying rent, but that rent is going into the director's pension, tax-free. So rent paid to the pension. So rent is paid to the pension and not a third party. So in that scenario, the business is paying into the director's pension pot, right, as a rental, as rent. So business is saving corporation tax on the rent, and then the director or the directors who are getting rental income into their pension are not paying any rental income tax, right? So it's a nice little tax efficient circle here. Of course, if the business owns, or rather, if the pension owns the property, it's safe from creditors. So if in that unforeseen period where if the business fails, for example, the property is safe because the pension is, the pension is the owner, not the business. So those businesses that own their property or their office, and it's in the balance sheet, those businesses are at risk if they fail because the property can be, obviously will be sold to pay off creditors, right? So that the ownership of the property is at risk. But with a pension, it's not at risk. So it's safe from creditors. So that's, again, a good point for business owners to think about. Obviously, owning your own premises gives you extra control. You can do whatever you want with that premise, obviously within reason. And you're not dealing with any unreasonable landlords. Like, when you're renting out your office from landlords, you're not dealing with, it's your own property except the pension owns it. And also consider if a business has a property that it owns, so it sits as a fixed asset in its balance sheet. By selling that property into a pension, it can release some cash, right? So the pension buys the property, and by buying it, obviously there's an exchange of money, and the business gets a cash injection by selling that property to a pension. So all these are sort of benefits to think about, but obviously one of the biggest benefits for businesses is that tax circle I spoke about. Of course, a good point to mention here, these are your pensions. So once money is in there, you can't access it until you reach your earliest retirement age, which is 57 as of today's rules. And so that money is sort of saved for retirement, really. So you can't have access to your pension funds before the minimum pension age, right? So that's something to consider. Of course, you can sell the property within the pension whenever that's feasible. You don't have to wait till retirement. And a pension can have multiple properties in there, but you can only access the funds after the earliest retirement age. Okay. Another fact to consider is the providers themselves, so the SIP administrators. Of course, they're quite strict, right? As I said in the beginning, commercial property, all of it has to be commercial. There can't be any residential element to it, and the SIP administrators will ensure But there's nothing like that. So there's no residential component also, and it's an arm's length transaction. So you can't tell the SIP guys, let's undervalue my property or overvalue it or whatever it is. It's done at the market value. The loans, if the pension is borrowing, for example, it'll be at a commercial rate. So all has to be, it's everything is sort of administered by the SIP providers, and of course they are sort of acting on behalf of the HMRC, and so they are following those guidelines and rules set up by the revenue, right? And so yeah, expect no favors from them. It is like I say, an arm's length transaction, and everything is done at market value. Liquidity is another thing to consider. So let's say someone's reaching their retirement age, and there's a property in their pension, and obviously you have to sell your property. So it's the liquidity wise, there's a risk of the property not being bought, or and so there is that liquidity risk, and which you have to plan for. And it's not like you can sell properties within a week. It takes time, and so you have to consider the fees, the liquidity element. Fees again, fees could be twofold. So, for example, if you have an advisor, there could be fees there, but the main fees you've got to consider are the SIP fees, which is an annual fee for administrating and looking after the administrative bits, right? So, for example, in that scenario where I mentioned three SIPs coming together to buy a property, the administrator has to ensure that when rental income comes in, it gets split three ways. And if there are loans to be repaid, then they need to ensure there's sufficient funds to pay off the loans, so on and so forth. So they do have a job to do, and then they charge fees. So roughly, the providers I work with, on average, will charge about £500 a year for that piece of work. And pensions can be VAT registered as well. So commercial property can be VATable, so it can be sold with VAT. And so that's something to consider. Of course, VAT is added to the purchase price, right? But a pension can be VAT registered. So although it's paying VAT, it can recoup that VAT back. So that's something the administrators do well. And so, if your SIP is then VAT registered, when you rent out the property, or the SIP rents out the property, you have to charge VAT on the rental as well. So the pension in that case gets rental plus VAT, and then it has to do a VAT return and pay that back to the revenue. So it can have a VAT scheme. So here I've just mentioned a scenario here. So ADC are in business, and they're operating a restaurant in Asheville. Okay, so here's where a business has been renting their premises since the time they were in business, and over that time they've accumulated strong reserves, strong cash reserves, and what they could then now look at is, should they invest in the premise, in the restaurant, via their pensions? And in this example, if they were to do it, they could easily utilize the money that's saved in their business, contribute a chunk of that into the director's pension pot. So in this case, 3 pots, and those 3 pots can come together to buy that restaurant, right? Again, the reasons why, going back to the tax benefits, the business is paying rent to the pension. It's saving corporation tax on the rent, but this rent is going tax-free into the pension, so no rental income tax on the pension, right? And any contributions that the business has made has saved the business corporation tax, and this can continue, right? So once this deal is done, the business, provided it's a going concern and is making money, can continue to fund the directors' pensions. And what the directors can then do is, like, if they open another restaurant, can buy that restaurant through the pension. And now, the pension will have 2 restaurants. So that's something you can do. So hope that example is clear. Obviously, that's it's ideal for business owners who are renting their premises, but for businesses that are not renting their offices. So, for example, let's take an IT contractor, right, who has accumulated a lot of cash reserves and now wants to sort of mobilize that money. So this is a way of doing it. You can contribute to a SIP, utilize your last 3 tax years. Anyway, a chunk of the money can be put into a pension, and commercial property can be bought, and you can, the pension can rent that out. In this case, to an external party, and your return is made of rental income. So you've mobilized your business cash reserves that are not doing anything. You've gone and put it into a pension, thereby saving corporation tax, right? Or getting a corporation tax refund as well. That can happen. And then the pension has bought this property, so it's invested. You're getting returns. You're getting it tax free. So a lot of reasons why you should consider. Okay, so scenario 2 is an individual, a landlord who has a portfolio of buy-to-lets. So obviously they have experience with buying and renting out property. Now, someone like that can easily look at mobilizing their pensions to buy their next property, right? Obviously, in this case, it has to be commercial. But maybe if they have sufficient savings, they can contribute to their pension, buy the commercial property. Obviously, because they're individual landlords, they're already paying income tax on their rental income, right? They're already doing it because they've got a buy-to-let portfolio. But the next purchase can be a very tax efficient one if they think about commercial property. And if they don't have the funds to pump into their pension, maybe consider selling one of the buy-to-let residential properties, putting that money into a pension and buying a commercial property, which is so tax efficient, right? But again, remember, you don't have access to that money until you reach retirement age, right? That's something to consider. So yes, again, this is the example goes on to say, that you can utilize capital, in this case, to buy a warehouse, rent it out. The rental income is tax free. And again, another important point which I mentioned earlier is capital gains. Individual landlords have capital gains to worry about when you sell your buy-to-lets, but no capital gains when you sell your commercial property, which is bought by your pension. So another big reason to look at commercial property and think about purchasing it through your business. Yes. Yeah, that's it really. I know it didn't take, I didn't need an hour for it, but Shyam, we'll open the forum for questions. I'm sure there will
Yeah,
be.
we already have a few questions in the chat here.
Yeah, okay,
So
go for it.
the first one being, when you buy a commercial property, do you buy the business along with the premise? So that's one of the questions. The first one probably.
So say, let's take an example of a shop. So if a shop owner is selling the property, it could be the business, or it could be just the shop. I mean, if the shop owner is selling the business and you're buying to run that business, the property can be it's the property that the pension buys, right? Not the business. So the pension buys the property, and then you rent out the property from your pension, if that makes sense. And so you're running the business as a shop owner. You have your, the business is obviously different to to now the property which is owned by a pension. So there are two different things here, right? So you're running the business as a shop owner, generating income, and one of your expenses there, in that case, is the rent you're paying out for renting out the shop, but you're paying it to your pension. And so yeah, the pension doesn't buy the business; it just buys the commercial element of that business, which is the the brick and mortar, the shop itself, the property itself. I hope that answers that question.
That should do for that. The second one is now when we go for outside funding, like a loan or
Yeah,
mortgage or whatever, the
yeah,
question is within that 50%, if there is a business loan apart from the mortgage, does that fall into the 50% or outside of the
yeah.
50%?
No, any loan, mortgage or outside loan or any sort of financing is up to 50%. It can't go beyond 50%. So if a mortgage, if a bank only lends 25% of the value of the pot, then you can go for another 25% from another lender or from another business or from another individual. But all your borrowings have to sum up to 50% of the value of the pension. Okay.
So, yeah, that should do for that. And the next question is now, with the increase of work from homes and office spaces going obsolete in certain industries, is there a risk to the property value declining in terms of commercial use? And what would be the options in that case if you're locked in? If you've bought it outright
Yeah.
cash and
Yeah. Okay. So, okay, in the event of commercial property declining in value, which can happen, I mean, that can happen to residential properties as well. Well, of course, over time, the any property is going up in value. But let's say commercial property in this question, let's say it has reduced in value. You can sell the property at a loss to retirement age to sell the property. You can hold the property till retirement as well, or even after retirement, you can still hold the property because remember, if that property is let out, there's still rental income coming in, and that rental income could be good enough for you to sort of drive or derive an income at retirement. So you may not have to sell the property. You may choose to keep it and still have a retirement income coming out of it. Obviously, we're talking about a time when you are retired, right? But in terms of selling the property before retirement age, yes, possible. A pension can sell that. It can hold it for a year or even less. There's no sort of time restrictions in selling the property. If you find the investment has gone down in value and you want to get rid of the property, sell it and then invest that money, in funds or stocks or whatever. So there is flexibility there. It's not stuck. The property is not stuck in the pension. You can get rid of it. I hope that's clear.
yeah, that makes sense.
And that
Also,
answers.
on that
Yeah.
same note, could you just walk us through when the rent comes in and if there's no
Yeah.
commitment, obviously it's just cash lying around in the pension, and when you
Yeah.
sell the property, it's once again cash lying around with the pension.
Yeah.
So,
Yeah.
what are the options for an individual here with this? For example, the rent that's coming in, the cash that's
You
just
know,
sitting in
yeah.
the property
So
pension.
that's good. Yeah, you can have that invested. So over time, obviously, rental income will build up a surplus cash sitting in the pot. You can use that to buy another property or invest it in funds or stocks or whatever. It's a SIP, which means it's a self-invested pension policy. You can do, yeah, you can buy and sell shares. You're sort of administrating the investments here. So it need not, the rental income coming in need not sit as cash. You can have those funds invested into other asset classes, thereby diversifying your pension portfolio. Or, like I said earlier, you can build up enough cash to think about a second property. Again, it need not stay as cash, is what I'm saying.
Understood. That makes sense. We have
Yeah.
another question. So the first part of it is, can you buy residential property to convert it into a commercial? And the second half is, can you convert a commercial property to a residential with intention to sell all whilst being in the pension?
So the first bit, no, the SIP administrators will be quite aggressive about it, where they will not allow a property that has any residential component to it to be bought by the SIP. So you can't have intention to make it a commercial property. It has to be a commercial property. So what the SIP will then say is change it from a residential to commercial, and then they will look at buying it. Right. So the first scenario is not it's not applicable really. There cannot be a residential element to it when the pension is buying it. The second bit, that's interesting. So if there is a commercial, say, a project, right, and you're in the business of building houses, you can have a look at it. So it can be run through the pension administrators, and they will have an opinion on it. Because if we are turning commercial property into residential, obviously, if you're doing it as a business, the land that the pension buys, which is the commercial property we're talking about here, usually could be that for business or commercial, so agricultural land, right? Now, if the pension has bought agricultural land, obviously the purpose is for agriculture, for farms, right? Now, if you're changing the use of that land for residential elements, what the SIP providers will say is, yes, you can buy the land as through the pension, but if you're turning that into residential, they're out, right? They want the land sold out. So again, coming back to the whole residential element to it, even in that instance where the nature of the land that the pension buys is changing, they want that out of the pension environment. I hope that is clear. So there's no scope here for any residential element when it comes to pensions. It's very, very clear that it has to be all commercial. So
Right.
you can build commercial property on it, no problem. You can build offices on it and rent it out or sell it. You can do that, but you can't have residential, even though that's as I know where the question is coming from, because it's a business intention behind it. But because it's residential and now this property has changed its so the nature of for example, in my case, it was a farmland. It's now changed the nature to a residential area. Again, it has to be outside the scope. Yeah.
Right. That makes sense. And the next one would be the rental income coming from the commercial property. Is it considered as a pension contribution or just income into the pension?
No, just income. Contributions are different. So you have a upper threshold, a maximum allowance for contributions, which this year it's 60,000, next year 6,000, so on. But the rental income is returns on your investment. So if you think about it as the money being, let's say, invested in the stock market, any sort of returns is not a contribution, right? It's the gains on market returns. So that doesn't go under your contributions. So contributions and return are two separate things. Okay, so your allowance for the year is not eaten up by the rental income.
And most of the shops have flats with the shop. How do we buy those properties?
So yeah, so I touched on it in the beginning. A shop with a flat, the pension cannot buy this flat, right? So in that scenario, what the solicitors will do, they'll break the deed. They'll have a separate deed for the flat and a separate deed for the shop. And so the pension can then buy the shop, and the owner, whoever it is that wants to rent, or rather is buying that whole building, will have to buy the flat separately. So two properties. You have to break the deed. That's how that happens.
Right. So the next question is, in addition to investing the pension pot itself, can part of it come from the money from a limited company income after corporation tax and be invested same way as a pension? Which means part of it coming from company and part of it coming from the pension.
Yeah, yeah. Again, we touched on it. So you can have multiple parties owning the property. So the pension can be 50% owner, whilst the business can be the other 50, or it could be an individual, or it could be a group of individuals, or it could be a group of pensions. It can have multiple parties. So so let's keep it simple. Let's say it's a pension and a business that's investing. So you have two owners, right? One the business, one the SIP. And when the property is rented out, rental income will get split, and that's the administrator's role here. Half goes to the pension, half goes to the business. So business will get a rental income coming in, obviously 50%, right? Because it's a 50% owner of the property. So yes, possible.
While we're
Yeah.
on the same topic, Sunit, could it be the same individual co-owning the property with his own pension?
Yeah, it can happen. Yes, yes. Because and more likely to happen because with pensions, there's this restriction around how much you can contribute to a pension, right? So if I was a permanent employee, my employer would be contributing to my pension, and so that could be a considerable contribution for the year. And so I'm not able to personally then contribute because everyone has a 60K allowance for the year. So maybe if my employer is putting 30K, I can only put another 30K, right? But 60K may not be enough to buy the property. So, and although I have money saved up, my pension can't solely go and then buy it because even though I have the money to fund it, I'm not able to because of the restrictions and how much you can contribute, right? So in that scenario, yes, I could be uh, an owner as an individual and my pension owning an element of it. So it could be 30, it could be 50, right? Yeah, so yeah, possible.
So if now when we go 50-50 with the business and the pension, the rent will be a income for the business, which means that income is going to be liable for corporation tax, is it?
Correct. Yeah, definitely. Yeah.
And who are some of the SIP providers that allow commercial properties in pensions?
So I work very closely with a company called Investac. They're one of the leading providers. There are others. I mean, AJ Bell may look at it. There are certain providers who do not touch it. They don't have the expertise. So if you go to the likes of I think HL, Huggies Lansdowne, I don't think they will do it. So you also have to ensure that the provider you're going with has expertise, has experience, yeah, and so there's lots at stake here because I told you there's VAT elements as well. So go to a specialist provider for if you're getting into this space. Investec, as I said, is I think the one of the top providers of SIP for commercial property. Yeah.
That's about all the questions we've had so far. Just feel free to use
Okay.
the chat box for any questions. Oh, and there's another one. What's the typical amount of funding required?
So that obviously depends on the commercial property, right? I mean, if you go up north, you can probably get far cheaper properties than south. That goes without saying, but obviously that investments. I mean, a shop could be as cheap as 50,000, right? Depending where you get it. And so yeah, I mean, commercial property can range. So that really is it depends answer on where the property is at. On average, it's hard to say, but maybe the, the the deals that I've done with clients, they were on average around 300 grand. Recently did one for 250, so 250 to 300 to four, less than half a million, I would say. But I mean, if it's more than half a million, you're talking about big property there. So on average, I'd say around 300 is in my experience the average case size that I've done, right? And these properties were around in and around London, a bit of Greater London, but I've not seen cases where my clients have got, for example, shops or properties in Manchester area. I'm pretty sure they're cheaper there, but yeah, not that I've done any.
Right. So the next question is, should the tenants pay VAT along with the rent, and is it 20% VAT?
Yeah, it is. So you can imagine the tenant is also a business. So for example, in an office space, if they are renting out an office, it is a business that's renting out. So you may find that 9 out of 10 times they are also VAT registered. So the rent that they're paying with VAT, they're claiming it back as well. But the pension that's receiving that also has to do a VAT return. So again, maybe VAT neutral in that scenario. It's hardly that an individual will rent out a commercial property not for commercial reasons. Again, that's not done, is it? So tenants paying VAT, more likely than not, are VAT registered and can claim that VAT back. Yeah.
Right. So if someone was to start, I mean,
Mm.
looking at, so if you said the average value would be less than 500,000. So if we take the property value is 400 grand. And
Yeah.
if somebody was to start up, assuming that they, going to look out for a mortgage in the future, so 50% of that is going to be 200 grand.
Yeah.
How would you sort of map it out in the future years with the limitations in the allowances? And in terms of building up funds, would you recommend consulting a specialist, or would you recommend just building up 200 grand by just contributions alone, or would you recommend any investments through the pensions that build up within the next 5, 6 years?
So a few things to note here, right? One is that person going to look at buying this property solely? Because again, if that is the answer, then yes, you have to build up your pension over the years, or look at utilizing the last 3 tax years, utilizing any allowances that have been missed, topping up those allowances, and then creating a plan to top up your pensions every tax year from now till the time you have enough money in there to buy that, right? Or if you're able to pool with someone else, right? And that could be a third party who has, a considerable amount of pension funds lying around. You could have a joint property ownership. So two pensions, like I said, can come together. In that case, you don't have to wait long enough. You can have multiple parties buying that property. So, like a joint investment, right? But yeah, if it's coming from a sole pension, then yes, you have to build that up. Unless there's money already there, or consolidation can happen if there are previous parts you can look at pulling together. So there are ways around this. Um, like I said, you can consider borrowing as well. So it depends on circumstances of the client, and whether they're in business or not, whether they have pensions in the past or not, and we can draw up a plan, right? Given all those factors, yes.
Right. So I believe that's all the questions on the chat box, unless anybody has any more.
Okay,
But
great.
yeah, we've
Okay.
covered pretty much everything.
Okay, super. So, well, we're not too far behind on time, which is which is good. But look, thanks everyone for taking the time to join. I hope you got something out of it. I know obviously the recording will be shared by Shahan to all of you lot, and feel free to be in touch. Feel free to send this recording around as well. You may know friends, family, who are looking for an investment, and if commercial property is something they're interested in, then I would say by and large, consider that to be bought by a pension. If it's possible, do it. I can't see why you shouldn't because of all those tax reasons, right? It's a nice little tax efficient circle. And you know, I've done these with clients who not only have rented out their premises, but who are looking to sort of mobilize that cash that's just sitting in there and, you know, trying to invest that. So yes, you can buy a residential buy-to-let. Again, open up a limited company, move that money there, and the company buys the property. But there again, there's tax, right? You're paying corporation tax. But if you think about paying zero tax, more than zero, you're saving corporation tax. Think about commercial property. I think it is something good. It's out there. These rules have been out there for a while now, but it's not very popular. So I'm hoping, you know, this webinar has given you some value, and share that value. And please feel free to reach out, right? If you have any questions, if you want to know more, feel free to reach out. Okay.
That should be it.
All right, good. Thanks, Sean. Thanks for hosting, and again,
Thanks,
thank you
Anil.
everybody for joining. All right, thanks a lot. All right.